Saunier. Brent and I were actually messaging each other this morning because of all the most recent changes. So I'm going to skip the question, but let me give a quick intro. Brent advises business owners on all aspects of accounting, finance, tax, operational strategy, and best practices. He has 20 years as a business owner, CFO, controller in his past. He has a Bachelor of Accountancy from Georgia State University, and he is a well-respected thought leader on tax planning and all accounting matters with a special concentration on the dental industry. Last I heard, Brent, you guys were serving over 300 dental practices. Is that right? Oh, you want to take yourself off mute, Brent?
Sorry about that. Yeah, so we serve about 300 practices in over 40 states. So looking for an additional 10 states.
There you go. So I'm going to skip the other question because what's on everybody's mind is PPP. Big changes came out yesterday because we thought the Senate was going to beat up the bill that the House approved and knock things down like the covered period and all of that different stuff. Tell us what you know right now, Brent, and what does everybody who received PPP funds need to be thinking about?
Yeah, so essentially as of right now, the House and the Senate have both signed off on the bill. So it is going to President Trump for signature now. But essentially the key things is that the 8-week clock is no longer. It is now a 24-week clock. And also prior, you were required to use at least 75% of your PPP funds on payroll. That has been dropped to 60%, meaning 40% can be spent on rent, utilities, mortgage interest. One of the big things, and I do think there may be some more clarification, the 60% is now what they call a cliff. If you do not spend 60% of your PPP funds on payroll, you get the big goose egg, 0 in forgiveness. So that's very important. Now, the other thing, I think it's important, Ken and I were talking this morning, most of you should though spend 100% of your PPP funds on payroll. So administratively, especially for DSO, it's very burdensome to track all the expenses that qualify. So I would encourage you to maybe take a high-level look, and if you can utilize it all on payroll, it may save you some burden of tracking the little things. There is still additional guidance to come. As Ken knows, everything's changed. It feels like 100 times. So there's still questions on the FTE computations for full-time equivalent employees. Another big thing that changed is that the June 30th date is now December 31st, obviously. But, before, if you offered an employee a job and they declined to come back, that would not hurt your forgiveness. But there's another exception now that if you are not able to find qualified employees or unable to restore your business back to pre-February 15th operations, you potentially will be relieved of some of that negative hit on the forgiveness. So there is some additional leeway.
Awesome. Great. Thanks, Brent, for giving that nice overview, nice summary. Like you said, still going to be guidance that comes out from the SBA and Treasury around all of this. Can you just take a second and talk about the tax implications of the forgiveness of the loan? There's been a lot of back and forth on this, and it seems like the Treasury's really solidified what they're doing. The SBA is not going to try to trump that, and it doesn't seem like Congress is going to take this on. So based on what we know today, help us prepare for when the loan's forgiven. What do we need to be preparing for from a tax perspective?
So a couple of things. So prior to the Senate passing this bill, they were saying there was the ability to defer your payroll taxes out 2 years. Many payroll taxes that were computed on your wages paid. And they were saying if you took the PPP, you couldn't take advantage of that deferral. The Senate bill now does allow you to utilize both. So depending upon your specific cash position, you do have the ability to push out some of your payroll tax burden. The other big thing that caused quite a stir, I think Ken and I texted each other within 5 minutes when it came out, is the IRS basically said if you pay an expense with PPP funds, you do not get a tax deduction. So for example, you get $100,000 of PPP funds, you pay $100,000 of payroll, you cannot deduct those payroll expenses on your profit and loss statement. I know there's been a lot of people in Congress pushing back on that. I think that that's still potentially up for change. Some people look at it as they're being taxed on those PPP funds, and they're saying, well, that's not fair because it was supposed to be this tax-free forgiveness. You're really not in any different position. You've gotten free money to pay the expense. So it's all the mindset. And, Ken and Emmett and I have talked exhaustively from day one. You got to make decisions based on your business needs. So, the PPP forgiveness is obviously important, but you want to make the right decisions for your business, not just for forgiveness.
So here's a question then, because I would assume most everybody here is some type of a flow-through entity. So either they're a Schedule C filer, partnership filer, or an S corp filer, which means whatever profits they have in their business is flowing through their personal return. Based on your knowledge of the tax brackets, let's say we have a typical dentist. You kind of see the gamut with the number of practices you're serving. What's about the average tax bracket people should be thinking about? And then do I just take that tax bracket percentage and multiply it by if I get it all forgiven? Because that means, I have expenses that are not going to be deductible. Do I just multiply it by that? And then I'll know about what taxes I should be planning to, I need to set cash aside to pay?
Well, if you get the PPP funds and they forgive them, that is not taxable to you. What you're really losing is the ability to deduct an expense you would have otherwise.
Mm-hmm.
We teach our clients to always use the 40% number. So we do tax planning, as we mentioned yesterday, twice a year. And anytime that they are taking money home, we tell you to just 40% of that needs to go aside into your tax account to basically make sure that you have the bulk of your money aside when it comes time to pay it. But for most dentists, I would say 40%. However, a lot of ours with tax strategies, they're lower than that, but I think 40% say the top.
Outstanding. So I'm just going to push one step further on this one. So let's say I've spent $200,000 on these expenses with the PPP funds, and I ended up getting it forgiven. That $200,000, if I'm in, say, the 20% tax bracket, I would know that I would see an extra $40,000 of taxes this coming year that I hadn't planned on before, because now these expenses that I normally had that were deductible weren't deductible.
You could say that, but I think, Ken, the important thing here is if you're not doing tax planning, you have to. So this year is an anomaly. So even though you may not get the deduction for those payroll expenses, everything else is completely out of whack compared to a normal year. So your collections are down. So it's really, you got to look at your specific situation and do some strategic tax planning. It's hard to give one answer for all.
Yeah, that's great advice. Again, from the flow-through perspective of how most everybody probably is structured here, if you're not making quarterly estimated tax payments, that's something that you need to get some good tax planning around. If you want to make sure you're avoiding penalties, again, an organization like Brent's, or if you have another tax CPA that you work with and trust already, go to those advisors and they can help make sure you're avoiding penalties and you're setting money aside. We all have way too many stories of those friends who went and bought big boats and then found out that money actually needed to be paid to the IRS, and they end up with liens on their houses and all sorts of issues and problems. So Brent, thanks so much for being with us today. Any final words? We've got about 30 seconds left. Do you want to share?
I would just go back to, the cash flow has come up a lot. So I would encourage you, if you are the traditional mindset of looking at historical accounting, now's the time to really start looking forward. So planning out your cash flow for the next 12 months is vital. The first really dangerous part of this whole thing was the immediate shutdown or loss of revenue. But now I think this is just as critical is the recovery period, making sure you have the cash to survive until you get back up to pre-COVID levels. So plan.
Love it. Thanks, Brent.